All right, today we're diving into a strategy that's, well, it's pretty legendary. We're talking about the Donchian Breakout. And this isn't just some technical pattern. This is the system that settled a huge debate and proved once and for all that you could take total beginners and teach them how to make millions. Seriously. So it all kicked off with this one big question, a question traders still argue about today. Are the best traders just born that way? Do they have some kind of special gift? Or can you learn to be a great trader, just like you'd learn any other skill, like playing an instrument? Well, the answer we got came from this wild experiment, probably one of the boldest things ever tried on Wall Street. It started with a bet back in 1983. And get this, just 5 years later, that little bet had raked in over $100 million. It didn't just make money, it completely flipped our whole idea of what it takes to win in the markets.
Okay, so who made this bet? On one side, you had Richard Dennis, an absolute legend in the commodity pits. And his belief was simple. He could teach anyone, you, me, anyone, to be a fantastic trader. But on the other side was his partner, William Eckhart, and he was like, no way. He thought it was all about natural talent. You either have it or you don't. End of story. So to prove his point, Dennis goes and puts out these ads in the newspaper looking for trainees. And the people he picked, it's almost unbelievable. We're talking a security guard, a Dungeons & Dragons expert, an actor, just regular folks, most of whom knew nothing about trading. He gave them a very strict, mechanical set of rules to follow, and he called them his turtles, apparently, after a trip to some turtle farms in Singapore. And the name stuck.
So, the big question is, what was this secret system that made millions? What was he teaching them? Well, it was a totally different way of thinking about trends, especially compared to the moving average stuff we've already talked about. The heart of the entire strategy is something called the Donchian Channel. It was created by a guy named Richard Donchian, who's basically the grandfather of all trend following. And the beauty of it is its simplicity. It's just two lines on a chart. One line marks the highest high over a period you choose, and the other line marks the lowest low. That's literally it. No crazy formulas, no averaging, just the raw extremes. And right there, that's a huge shift in thinking. See, moving averages are all about finding the middle ground. They're asking, where's the average price? They want to smooth things out. The Donchian Breakout, it couldn't care less about the average. It asks a much more aggressive question. Did we just smash through a major high or low? It's not about the journey, it's all about that moment of breaking out. And this is where the real genius comes in. The rules were 100% mechanical. There was zero room for I think or I feel, no gut feelings, no second guessing. The turtles were basically told, here is the code. Your only job is to follow it. Don't think, just execute. And they had to do it with just, ironclad discipline. So what was in this code? Well, the first key number they had to remember was 55. 55 was all about their entry signal. They used a 55-period Donchian channel on a daily chart that's tracking the highest high and lowest low over the last 55 trading days. So think about that. That's roughly 2.5 months of price action. When the price breaks out of that channel, it's not just a blip. It's a really big deal. It means the market is doing something it hasn't done for an entire financial quarter. Okay, so that's the entry. The second number they lived by was 20. And this is so clever. 20 was for the exit. They used a shorter 20-period channel to get out of trades. Now, why would they do that? Well, think about it. You want to get into a trade based on a major, significant, long-term breakout. But you want to get out the moment that recent momentum starts to fade. The 20-period channel looks at about the last month of trading. So if the trend from the last month breaks, you're gone. It's this perfect combination, a very strict entry, but a much more nimble exit. And the actual rules for getting in were super precise, like a checklist. Step 1, you don't just buy because the price touches the line. Nope, you have to wait for the daily candle to close above that 55-day high. That's crucial. Step 2, you look at the volume. Was it an anemic little breakout or did it have real power behind it? You needed to see above average volume. If and only if you got both of those things, then you'd place your buy order for the open of the very next day. No ifs, ands, or buts. All right, so how do you get out? It's even simpler. Once you're in a trade, you just watch that 20-period channel. Your exit signal is a candle closing below the lower band, the 20-day low. The second that happens, you're out. The trade is done. This is what lets those winning trades just run and run for weeks, sometimes months, but it gets you out the second that short-term trend gives up the ghost. Okay, now for what might be the most important part of the whole thing, risk management. Because without this, none of the other rules matter. This was absolutely non-negotiable for the turtles. First rule, you never, ever risk more than 1% of your total account on a single trade. And second, they used a tool called ATR, or Average True Range, to size their positions. All ATR does is measure how much a market typically moves in a day. By using it, they could make sure that a trade in a super volatile market, like crude oil, had the exact same dollar risk as a trade in a sleepy market like corn. This was the secret to surviving the bad times.
So the story is amazing, right? But stories are one thing. Does this system actually work over the long haul? Well, lucky for us, we have the data. Let's look at what 40 years of backtesting tells us.
Okay, look, the win rate is about 55%. That's fine. It's basically a coin flip. But that's not where the magic is. The real power of this system is the risk to reward. On average, a winning trade makes 2.5 times more money than a losing trade costs you. And why? It all goes back to that design. Cut your losses short and let your winners run. It's the oldest rule in the book, and this system is built to do it mechanically.
But, and this is a huge but, you have to look at the other side of this. The maximum drawdown was 22%. Let me be clear about what that means. It means that at some point you would have lost nearly a quarter of your account before it started coming back. You have to be prepared to go through months where it feels like the system is broken, where you just take one small loss after another. Your mental game has to be incredibly strong to stick with it.
This really brings us to a famous quote from one of the turtles. He said, "You have to be willing to lose for months to win for years." And that just perfectly nails the mindset you need. See, systems like this make most of their money from just a handful of huge monster trends each year. To catch those trends, you have to be in the market. And that means sitting through all the boring, choppy times and taking those small losses, just waiting for that one big one to come along. Now, let's put this into perspective. If you look at this table, you might see that the EMA ribbon strategy we looked at before has a slightly higher return in Sharpe Ratio. And that's true. But look at the last row. The Donchian system has been tested over 40 years. Think about everything that's happened in the last 4 decades. Market crashes, tech bubbles, financial crises. This system has seen it all and survived. That 13.5% average annual return over that long of a period, wow. That's not just a good backtest. That is some serious robustness.
So, okay, the numbers are good. But beyond all the data, what's the real lesson here? What did the turtles actually teach us?
Well, first, you have to know where this strategy works and where it gets destroyed. It absolutely thrives when markets are making huge, obvious moves. You know, like those big commodity cycles or the insane bull and bear markets in crypto. That's its home turf. But when the market is just flat, choppy, and going nowhere, this system will get chewed up. It'll give you false breakout after false breakout and just slowly bleed your account. So knowing when to just sit on your hands is just as important as knowing when to pull the trigger. And that really brings us back to the beginning. At the end of the day, Richard Dennis won his bet, big time. The turtles proved it. You don't need to be born a trading genius. What you need is a solid system with a positive edge, and then, this is the key, the unwavering, almost robotic discipline to execute it perfectly. That combination can be taught, and it can beat the market over the long haul. So I'll leave you with this final thought. As traders, we spend so much time searching for the perfect indicator, the perfect entry, that holy grail system. But what if the whole turtle experiment was trying to tell us something different? What if the most valuable thing you can have as a trader isn't your system at all, but simply the discipline to follow the rules you already have?